On the 17th floor of the Lipstick Building at 885 3rd Avenue in Manhattan, a small team operated an IBM AS400 mini-computer that printed customer statements. Those statements showed executions in blue-chip equities and OEX index options. The trades cleared no exchange. They settled at no counterparty. Frank DiPascali, who ran the operation, later testified that he selected each day's prices from published trading ranges after the market had closed, choosing figures that produced the smooth returns the strategy promised to deliver. No securities were ever purchased. The question this episode answers is not why customers believed the statements. It is how a paper record with no underlying transactions sustained the appearance of a functioning investment strategy for more than a decade and a half. The instrument at the center of this case was not exotic. It was a strategy Bernard L. Madoff Investment Securities LLC described to clients as split-strike conversion. Legitimately, a split-strike conversion is a real and unremarkable options structure. An investor buys a basket of stocks correlated to an index. To limit downside, the investor buys index put options below the current price. To finance those puts, the investor sells index call options above the current price. The result is a collar. Gains are capped, losses are cushioned, and the portfolio tracks the index within a defined band. Executed properly, the strategy produces modest, bounded returns. It also produces friction. Options have bid-ask spreads. Stock baskets must be rebalanced. Entry and exit timing affects results. A real split-strike conversion generates a return series that is choppy, that shows losing months, and that correlates visibly with the index it tracks. What Madoff's advisory business reported did none of those things. According to the SEC's enforcement record, the investment advisory operation reported consistent positive returns across nearly every reporting period, in rising and falling markets alike, with almost no correlation to the movements the strategy would necessarily have inherited from the index. The strategy that was described could not have produced the results that were reported. That gap is the entire case. Everything else is the machinery built to conceal it. Understand what a legitimate split-strike conversion cannot do, and you understand what the reported numbers proved. It cannot deliver smooth returns because the collar tracks an index that is not smooth. The distance between the strategy's description and its output is the measure of the fiction. The architecture rested on a division that most clients never saw. Bernard L. Madoff. Investment Securities operated a legitimate, registered market-making and proprietary trading business. That business occupied the 18th and 19th floors. It executed real trades, employed real traders, and was, by the account of the SEC filings, a functioning broker-dealer. The fraud lived one floor below, on the 17th floor, physically and operationally separated. The investment advisory business that managed customer money was not registered with the SEC as an investment advisor until 2006, and the record establishes that its activity was deliberately kept apart from the legitimate operation. Step 1. Customer funds arrived and were deposited into an account at JP Morgan Chase, identified in the record as the 703 account. Those funds were not invested. They sat as cash, or were moved out to meet redemptions and to fund the personal and business expenses the record later itemized. Step 2. The 17th floor operation generated the trade record. DiPascali testified that after the market closed, staff selected historical prices for the securities the statements would claim to hold. Because the prices were chosen from ranges that had already occurred, every reported trade was, by construction, profitable within the band the strategy promised. There was no market risk because there was no market position. Step 3. The AS400 produced the confirmations and statements. These documents showed specific lots, specific strike prices, specific execution times. They carried the texture of real trading. The record establishes that the system was programmed to backfill trades that reconciled to the returns Madoff had already decided to report. Step 4. Redemptions were paid out of the 703 account, funded by incoming deposits from other customers. This is the structural core. There was no trading engine generating returns. There was only a cash account into which new money flowed and out of which old money was paid. What made the reported returns possible was not any investment performance. It was the continuous arrival of new principal. The SEC and the subsequent bankruptcy trustee established the total of fabricated account balances at approximately $65 billion. That figure was not money lost in the market. It was the sum of fictional gains printed on statements. The actual cash that passed through was a fraction of it. The strategy description served a specific function in this architecture. It gave the smooth returns a story. A client who received a statement showing consistent gains needed a plausible mechanism, and split strike conversion supplied one that sounded sophisticated enough to explain the results and dull enough to discourage close questions. The description was the cover for numbers that a real version of that same description could never have produced. Consider what the scale required. To report positions in OEX index options consistent with the volume of assets under management, the advisory business would have needed to hold option contracts exceeding the total open interest that actually existed on the exchanges. The claimed positions were larger than the market they claimed to trade in. That fact alone was verifiable by anyone who checked the reported option volumes against exchange data. So the detection failure is the heart of the structural story. This fraud did not survive because it was hidden. It survived because the verification chain that should have checked the trades against reality was, at multiple points, either absent or captured. Begin with the auditor. The advisory business's books were audited by Freeling and Horowitz, a firm that the record establishes consisted of a single active accountant operating out of a small suburban office. A registered investment operation reporting billions in assets was audited by one person. The record shows that the firm did not conduct meaningful audit procedures. For the fraud, this was structural. The entity whose job was to confirm that assets existed did not attempt to confirm it. The auditor is the point where verification is supposed to originate. When the auditor is a single person performing no substantive procedures, no downstream gatekeeper can rely on the audited figures. The entire chain inherits an unverified foundation. Next, the custody structure. In a legitimate advisory arrangement, client assets are held by an independent custodian and a third party can confirm the securities exist. Madoff's operation was self-custodied. The firm was the broker, the advisor, and the custodian. There was no independent party who held the securities because there were no securities. The statements were generated internally and confirmed by no one outside the firm. Next, the feeder fund structure. Much of the capital arrived through feeder funds, entities that pooled investor money and placed it with Madoff. These funds collected fees for managing the relationship, but the record establishes that many performed no independent verification of the trades. They received the same fabricated statements the direct clients received and passed the reported returns to their own investors. The feeders added a layer of apparent diligence without adding any actual verification. Finally, the regulator. The SEC received specific, detailed warnings. Harry Markopolos, an independent analyst, submitted analyses beginning in the early 2000s arguing that the returns were mathematically implausible and that the option volumes required did not exist. He identified the split strike return series as impossible to reconcile with the market. The SEC's own Office of Inspector General later found that the agency conducted examinations and inquiries but failed to perform the basic step that would have collapsed the entire structure. Independently confirming with the depository trust company and the options clearing corporation whether the trades on the statements had actually occurred. One confirmation request to a clearinghouse would have ended it. That request was never effectively made. What would have had to be true for earlier detection? Only that a single gatekeeper compare the claimed trades against clearing records. The information was public. The failure was not one of access. It was that every party in the chain relied on the statement rather than the settlement. The unraveling followed the mechanics of every Ponzi structure. It required continuous new deposits to fund redemptions. In 2008, as the financial crisis deepened, clients across the market sought liquidity. Redemption requests to the advisory business rose sharply. The record establishes that requests reached approximately $7 billion against a 703 account that did not hold anything close to that sum, because the funds had never been invested and much had already flowed out. The arithmetic was terminal. New deposits could not cover the redemptions demanded. On December 10, 2008, Madoff told his sons, who worked in the legitimate trading business, that the advisory operation was, in his words in the record, a giant Ponzi scheme. They reported the statement to authorities. On December 11, 2008, he was arrested. The enforcement record moved quickly because the mechanism, once stated, required no complex proof. There were no trades to trace, because there were no trades. In March 2009, Madoff pleaded guilty to 11 federal felonies, including securities fraud and money laundering. Frank DiPascali pleaded guilty and testified in detail about how the fictional prices were selected and the statements generated. David Freeling, the auditor, pleaded guilty to charges arising from the audit failure. The bankruptcy trustee, Irving Picard, began recovering funds by clawing back amounts paid to earlier investors in excess of their principal, since those payments had been made with other investors' money. What this case establishes about the mechanism is precise. A Ponzi structure does not require sophisticated instruments. It requires only that the record of assets be generated by the same party that holds them, and that no independent gatekeeper verify the record against settlement. The split strike conversion strategy contributed nothing to the returns. It contributed a plausible narrative for numbers that were entered into a computer after the market closed. The regulatory response addressed the specific verification gaps. The SEC restructured its examination approach to require independent third-party confirmation of custody and trade settlement rather than reliance on documents produced by the examined firm. The Dodd-Frank Act of 2010 expanded investment advisor registration and examination requirements. The custody rule was strengthened to require, in most cases, verification of client assets by an independent party. The finding is structural. The fraud did not defeat the verification chain. The verification chain was never engaged. A single confirmation to a clearinghouse at any point across 16 years would have found nothing on the other side. The absence of that confirmation is the mechanism.